This is TreppWire Week in Review for week ending October 29th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us this week is Orest Mandzy, Managing Editor of Commercial Real Estate Direct. This week, President Biden rolled out the details of his $1.75 trillion spending bill, and the FDA recommended Pfizer's vaccine for children ages 5 to 11. Economic data released underscores a recovery slowdown. Third quarter GDP grew at a 2%, the slowest since 2020 as consumers tapped the brakes on spending. Orders for durable goods dropped last month for the first time since April, and pending home sales fell last month. On the positive side, consumer confidence for October rose and unemployment claims hit another post-pandemic low. Manus, the spending bill, earnings, a flattening treasury curve, which of these or all of these are investors paying to the most right now?
Well, by and large, until about 4 o'clock today, earnings were everything. And every one of these concerns that you brought up were really getting shrugged off. So the really weak GDP, people were expecting a 4% initial GDP reading. We got 2%. We're watching things roll out like the potential wealth tax, right? A mark-to-market accounting of capital gains for billionaires that was floated this week. We have supply chain issues, but through it all until 4 o'clock today, it was really water under the bridge. And in fact, today, the NASDAQ and the S&P 500 hit new all-time highs. In the 10 minutes after today's closing bell, I think we had a reckoning of sorts. First, Amazon came out with their earnings, sizable top line miss, really sizable bottom line miss, and guidance that was incredibly underwhelming. So its stock was off between 3 and 5 points in the 15 or 20 minutes after those earnings came out. And maybe you thought that was a one-off, but a few minutes later, Apple came out similarly negative results where they said supply chain issues had cost them $6 billion in revenue. Their stock price was also off about 5% in the immediate aftermath of the announcement. So those are the kind of things when you consider how much those two stocks make up individually of the S&P 500 and the NASDAQ on a market weighting basis, that's the kind of thing that could jolt the markets tomorrow. And it could be the kind of thing that erases all of this shrugging off that we've seen about supply chain inefficiencies and other problems. So Friday could be a bumpy day.
Yeah, I think I was looking at a lot of the same stuff, Manus, in the last couple hours. As I was writing down my notes, I had GDP, Amazon, Apple, a couple of kind of earnings calls from some of the REITs and CBRE and Zero Hedge quoting a JLL report about retail rents in Manhattan being off by significant, very, very significant numbers. But these like Midtown retail, we know, we've been talking about that for a while. Hotels, coming back, but not coming all the way back. We know like that, but Amazon and Apple, like those are the ones you're always trusting. Now, granted, they still made a ton of money, and Amazon still had, I think it was something in the range of 15% revenue growth, but they had been at 30 and 40 over the last several quarters. Seeing those kind of come down, put all that together with the inflation we're seeing, stimulus checks running out, unemployment running out, right? Like it has that feeling, right, of this could be the canary in the coal mine here, that the V-shaped recovery has plateaued.
Are you running out this weekend, Joe, to buy beef jerky and a 3-year supply of rice? Is that what I'm hearing?
No, I was actually trying to log in to buy Amazon, but I can't buy after hours. This thing, if they just spun off AWS on its own, I think it would probably be worth enough. But anyway, I do think that the consumer maybe, and I think when Martha was reading that the consumer confidence number was good, that's a little scary to me, right? A surveyed consumer confidence is now at highs when the actual consumer spending on Amazon is not growing as much as it was. People aren't buying as many iPhones. That makes me a little bit worried.
Yeah, I mean, this could be a tipping point. A lot happening over the next week. I think today could be an inflection point with those two disappointing earnings numbers. We have so much unknown coming out of Washington. It seems like every day a new plan comes out for taxation, for spending, for what's a priority, what's not a priority. A big election next week in Virginia, which may also kind of give a sense of which way the prevailing winds are blowing. And, you know, I think if this is continuing through Black Friday, right, and people are saying, you know, shelves are bare, supply issues are a real problem, we're not finding things at any price, we could see that correction we've been talking about for a long time.
Manus, you better be careful, because I heard with that unrealized capital gains tax that they might be coming after your trading card collection from 8th grade.
Man,
they might come in and just rip off 40% of each card.
All those old. Well, you're really talking 70s. You're talking the old Pete Roses and Tony Perez and Willie Mays, Roberto Clemente, right? Those are the ones. Although, like most guys my age, 75% were thrown away, and the other 25% made it into the spokes of my bicycle to make that clicking noise when I rode around Stony Brook on Long Island.
So that was you.
Commercial Real Estate Direct just released its inaugural quarterly data review, which summarizes CMBS and CRE data, a lot of it comprised of TREP's own data. Orest, why don't you give us some of the highlights of the quarterly data review, which, by the way, is available for free if you reach out to us at podcast@trepp.com. We'll send it to you.
If it wasn't for COVID times, you'd find it at newsstands everywhere.
Yes, sir. Thanks so much. So what we learned is that the commercial real estate market continues to improve, unlike the broader market, and it's improving rapidly. I mean, if we just look at special servicing numbers and delinquency numbers, special servicing at the end of September was down 22.5% from the beginning of the year, and delinquency was down 32% over that period. What's most significant is that the volume of distress in retail and hotel, which were hardest hit by the pandemic, improved markedly. Hotel, for instance, delinquency is now only 11.6%. That's down from more than 20% at the start of the year. And retail, it's down to 10% from 13.3% at the beginning of the year. We can talk about the market's improvement a little later, but I wanted to jump into our CMBS rankings right away. As Darren noted last week, we saw a total of $67.8 billion of private label CMBS issuance and a whopping $32.9 billion of CLO issuance. Now, the CLO issuance was a 420% increase from last year. So we're digging into what's going on in the alternative lending space right now, because it's on absolute fire. Blackstone Mortgage Trust, for instance, originated a record $4.7 billion of loans in the third quarter alone. And they're not the only ones hitting records. Let's go back to the CMBS world. JP Morgan Securities, Goldman Sachs, and Citigroup were the top book runners, collectively accounting for about 42.5% of all private label issuance. And the three also were the biggest contributors of loans to deals, with about $9 billion each of contributions. That was driven, their contributions were driven by their huge participation in the large loan business. We had 72 single borrower deals with a balance of $44.5 billion priced during the first 9 months. JP Morgan contributed $7.7 billion of loans to that bunch, or 17% of the total, and Goldman Sachs 7.4%.
I just want to throw a quick curveball at you, and then we'll continue with the numbers.
Sure.
From 2005 to 2007, you lived through the prior wars just as I did. We saw a huge run up in volume. We saw an all-time high in 2007 of about 230 billion.
Yep.
And that was everybody racing to securitize really expensive assets. And we know how that turned out. What is your gut feel right now as we're seeing this volume run up? Is this another canary in the coal mine, or are we on firmer footing?
It's we're looking at the underwritten numbers, and mind you, underwritten numbers pre-GFC were a little inflated, but all signs point to the fact that these are relatively conservative loans, at least on the conduit side. Your typical conduit deal has an LTV of like 55% to 60%. It's seldom that you see anything more than 60% LTV. And coverage ratios are well into the 2 times. Granted, we're seeing more and more interest-only loans, which could be problematic if we have enduring inflation. That could be a problem going forward. But right now, it looks like these things make sense, at least if you're valuing these things that the loans are 50% LTV and nothing more. But, time will tell.
So Orest, I was looking at the data review. By the way, I love like this flip book thing that you guys do where we can just kind of open it. You don't have to download the file. It's very cool. And on the CLO side, the commercial real estate CLO stuff, which you mentioned, 32.9 billion in the first 9 months of 2021. And I don't know if you're going to talk about it later, but we mentioned yesterday that in general, mortgage REITs, which are the big kind of issuers of these things, tend to finance about 20 to 25% of their loans with commercial real estate CLOs. Is that fair? Right. So very, very broad brush numbers here. That would indicate that there's like 120 billion potentially that mortgage REITs have either originated or just refinanced on their balance sheet, right?
Yeah, that's right. Yeah. And one of the things to keep in mind, so prior to last April 2020, a lot of alternative lenders relied on the repo market.
Right.
They got clobbered with mark-to-market calls. So they decide they're all migrating towards more match-term funding, and CLOs fit the bill perfectly. So let me get back into the ratings. We'll jump into risk retention for now. So as you all know, since 2016, investors have to maintain a certain amount of risk in CMBS and other structured bonds. So Prima Capital was number 1 in the entire risk retention market in CMBS. It bought the horizontal bonds of 10 deals amounting to $463 million of bonds. Right behind it was KKR, which bought into 10 deals, 9 structured as horizontal and 1 vertical. Its take was about $415 million. More importantly, KKR bought 3 horizontal strips from conduits. Now, that's the real risk, because these are typically 10-year bonds, and you're buying the most subordinate, highest risk pieces. Your skin is in the game the longest for those. Those 3 deals amounted to $242 million of bonds. And Argentic bought 2 conduit horizontal strips for $72 million. So on the BP side, so you're buying the subordinate bonds, but not subject to risk retention rules. The 4 most active buyers were Rialto, Prime Finance, Eightfold, and KKR. Rialto bought subordinate bonds from about a quarter of the market's conduit issuance. Those deals were all structured with vertical risk retention, though. And it looks like 11 of the 22 conduit deals were structured with horizontal retention, and vertical structures, as we know, don't entail much retention of risk because roughly 80% of the bonds that are retained carry AAA ratings.
Joe, why don't you give our audience, just for those that are not in the CMBS market, a 3-minute
the educational segment
on risk retention and the difference between a horizontal cut and a vertical cut.
Yeah, this is for all our CRE folks out there who are not CMBS savants like Orest and Mandzy, more peasants like me. In 2016, post GFC, a law was enacted as part of Dodd-Frank, which required issuers of mortgage-backed securities to hold on to some risk when they issue these deals. So if JP Morgan puts together 100 commercial real estate loans, package it up into a CMBS deal, they create a bunch of bonds or tranches, it is incumbent upon JP Morgan to hold or retain some of those bonds or a portion of those bonds. Now, there's a couple of wrinkles. You can retain a portion of each bond from top to bottom, which would be called the vertical way. You can retain a portion of the very bottom, which would be a few of the tranches at the very bottom. And you can also sell a horizontal piece to a qualified B piece buyer, right? So there's essentially the idea is if you're forced to hold on to some of the bonds, you're going to be a little bit more careful in your underwriting and loan selection and stuff like that. So I guess Orest was talking about how most of the conduits were done with the horizontal approach, which is interesting because when it first started back in 16, it was actually, I remember, it was Christmas Eve of 2016 when it got enacted and we started reporting on it. But at that point, they were kind of messing with the different structures, right? Horizontal, vertical, and L-shaped, which could be real fun. So